This meeting is being recorded.
Y'all have been informed it is being recorded.
Oh, good. I was hoping
Thank you.
it would be. All right. Who do we got here so far? All right. Here they come. People are coming in now.
Excellent.
There we go. Hey, Dylan, Frank, glad you guys made it. Jessica. Awesome. We'll get started shortly, guys. Just going to give people a few minutes to jump on in.
Yep.
Just need some background music, you know.
I know, right?
Do your beatboxing. Okay, that was weak.
Hey, listen.
Gotta get it.
I'll stick to real estate, all right?
Nice.
All right, Francisco, how's it going, man? Thanks for joining. I think my mom just joined Jane's MacBook Air. Happy to have you on here, Mom. Thanks for the
Take a
support.
stand. Take a stand. Gotta shut my emails off.
All right, for those of you that are on, we're going to give it just a couple more minutes. Let some late stragglers come on in.
Hope everybody had a great Thanksgiving holiday.
Absolutely.
Cool.
We just finally got rid of our Thanksgiving leftovers, cleaned out the fridge.
Yeah, can everyone type in the chat box? If you guys can hear me, go ahead, type in the chat box, just say hello real quick. Make sure the chat box function's working. Are we getting any? Can you see any, Megan?
Nobody yet.
Okay.
You guys just want to say hi and tell us where you're from.
Oh, we got a Q&A. Disabled chat. Oh, great. Thanks, Joe.
Oh, goodness. Okay, let me see what I can do about that. It's disabled.
Okay. If that's the case, we can
That's
put
okay.
any. Yeah,
I can fix it.
that's what I like to hear.
Pivot.
That's why we got
There we go.
Megan.
Try it now, guys.
There we go.
Ta-da!
Great job, Megan. Thank you.
Nice. Thanks, guys. Yay.
Awesome.
Nice.
Hello. I love Eric. Hello.
Fan club, dude.
Tyler Burke's here from Kansas City. Awesome.
Right.
What's going on, Tyler? Let's see.
It's awesome.
Dylan Davis, Boise,
Boise.
Idaho.
Oh, man.
Francisco. Dylan is one of my longtime closest friends. He taught me everything I know about communication and sales. So he is the man.
Awesome.
Nice.
Matt Ramos. Yes. Matt Ramos.
Dallas is in the house.
Awesome. Sweet. Well, we got more people join in. What do you guys think? Another minute or two, or you want to get started?
What time is it? Want to be
6:03.
respectful of everybody's time. I'm gonna be
Let's-
just two more minutes.
Yeah, a couple more minutes. In the meantime, for those of you guys that haven't, why don't you go ahead and type where you're from? I just want to get to know you guys a little bit more. So we got some people from Connecticut, Dallas. Who's from Boston? Curtis. Curtis, we spoke yesterday. Great to see you, man. Glad you're joining. Connecticut, Charlottesville.
Nice.
All right, Stephanie. Cool. Yeah, Brett, you know Francisco.
Brett's
Seattle.
fan
There we
club.
go. Seattle-ish.
Jane.
That's great.
What
We
does
love you, Jane.
Seattle-ish mean? Seattle-ish. Okay.
Arizona, but Denver now. Is that Mr. Connor?
Yep. AZ, but Denver.
Love it.
Glad you're on here, Mike. Okay. All right. Well, I say we get started here. We're 4 minutes past. I appreciate all you guys for showing up on time. And I say we just get the ball rolling. So first and foremost, you guys, welcome. We are extremely excited for today's webinar and just to add as much value to those of you guys that showed up as we can. For those that don't know, my name is Eric Chatterton. I'm one of the co-founders and managing partners here at Gibby's Capital Investments, and I also head up all of our investor relations as well. Now here at Gibby's, we focus on the acquisition and management of value-add multifamily properties, and we specialize in repositioning well-located assets in what we call emerging markets. So our highest priorities are to protect our investors' capital, provide high yield returns, and also build relationships with you guys that are long lasting. So not just for one deal, but for many deals to come over the years. And Gibby's as a whole, has a combined experience of almost 40 years of real estate experience. And once we close on our latest offering, which we have under contract right now and still does have some availability, we'll have acquired over 800 units and over $80 million of real estate, multifamily specific. So we're very passionate about what we do, and we're very passionate about helping others to participate in some of these opportunities with us. So before we get started, I want to get a better understanding of where everybody here is currently at. So I do have a poll question that I've queued up for you guys. So I'll have Megan put it up on the screen right now. There's no wrong answers. Answer honestly. But the question is, have you invested in real estate before? Yes, 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 yes. No, but I want to. No, but I want to. Awesome. Awesome. We got a few extra people that haven't, but thank you guys. So I think we can end that poll. A lot of people that have some experience, which is great. That's what we want. And I appreciate you guys taking the time to answer that. But today our webinar topic is why oil and gas professionals invest in multifamily real estate. So on this webinar, we're going to be discussing just a real life concern at hand, a very real one. So we're going to discuss the volatility and cyclical nature of the oil and gas industry. We'll also discuss ways to mitigate some of that risk through some incredible benefits of multifamily investing and investing in these properties with us. Benefits that include diversification, tax benefits, how investing in multifamily can be a hedge against inflation. There's high appreciation with these properties, both natural and forced. We're also going to talk about how multifamily investing or multifamily properties are actually easier to manage than single family. We'll talk about how it's completely passive in nature for you guys, the potential passive investor. And best of all, my favorite, cash flow and equity. So before we go into this too much, I want you guys all to understand that we know that there's a ton of money to be made in the oil and gas industry. So for those that are in the oil and gas space or invest in oil and gas stocks, this is not meant to replace what you're currently doing, but more so to complement it. Okay. We want to help people be prepared, and we want to help you to put your hard-earned money to work for you. So, and we want to help you do it in a different and alternative way than what you might be familiar with right now. Something different than traditional stock market investing, which is what most people are familiar with. So, outside of the stock market, most of the oil and gas professionals really just don't know that there are even opportunities like this that exist. And if you do, you might just not know a credible or strong team to trust. And we aim to be that team for you guys. So speaking of team, I do want to take a second and introduce my team. I love my team. And I truly believe that the operator team is the most important factor in the success of some of these investments. A poor operator team can make even the best investments underperform. But on the flip side of that, a strong operator team can turn almost any investment into a win, which is why we have worked so hard to put together this powerhouse of a team that we have. And so let's do some introductions real quick. First, we have Mr. Brett Davenport. Brett is incredible. He is a numbers expert. He does all of our finance, underwriting, and acquisitions for Gibby's Capital. He's got over 26 years of operational experience. He takes, an extremely conservative approach when he does underwriting for our deals. And quite frankly, if Brett isn't the one evaluating, vetting our deals, then I usually wouldn't move forwards with it. And I, wouldn't give it the time of day. Brett, his conservative approach gives me the confidence that I need, to go raise capital and, share these opportunities with potential investors. So we're extremely lucky to have Brett on board. Next, we have Megan Davenport, Brett's wife. And I don't know, where do I even start with Megan? She is our secret weapon, man. She does it all Honestly, she does. She's got over 10 years of construction and asset management experience. She's proven to be the perfect asset manager for our team. She has incredible organizational skills. Her systems and structures that she's developed have been a huge factor and what's also set Gibby's Capital apart. So Megan is awesome. Next, we have Mr. Jim Chatterton, also known as my father. So Jim is our most recent addition to the Gibby's team. He actually started by taking a solid position in a couple of our earliest properties, the Aspen and the Oasis. My dad is no stranger to multifamily investing. In fact, 35 years ago, he made his first real estate purchase. That was the start of a portfolio of single family houses. But as the portfolio grew, self-managing those properties became very difficult, which led him to pivot into multifamily. And that was 20 years ago. He earned, I don't even know, 3 degrees, I think, Dad. Is that right? 3 degrees, including an MBA from a top business school in Chicago. And then back in 2020 and 2021, he saw an opportunity to pivot again. So he sold all of his properties that he had in Oregon and redeployed those funds into passive investments into multifamily deals out here in Texas with us. So we're super glad you made the switch, Dad, and welcome to Texas. Next, we got Caleb Christian. Man, this guy is a rock star. If you don't know him, get to know him. He works with me as part of our investor relations team. He brings a massive amount of experience and value to the team. His professional background is serving as a licensed financial advisor and also senior wealth advisor. He basically would provide clients with various forms of financial planning, wealth management, and risk management services. He is a huge family man with his wife of 10 years and kids of 3, and he's got 3 kids as well. He's also a big golfer. Not sure who would win on the golf course these days through 18, but we'll find out next week, hopefully. But like I said, guys, the team is an extremely important factor here, and I'm not sure if I mentioned this to you guys, but, or not sure if you even knew this, but Brett and Megan Davenport are not only my business partners, but they're also my in-laws. I just married their daughter about a month ago, their beautiful daughter, Savannah. And if you've seen her, then you know that I married up. That is 100% a fact. So if you haven't noticed a little trend here, you'll see that we are the definition of a family operation. 4 of our members on this team are family. So we love this. And it's important for you guys to know that, because you'd be potentially partnering up with a team that all share the same morals and values, which is very important in any business. And Caleb, well, he's not family, but he's pretty much family to us at this point. So we love the guy. But that's it for intros, guys. Let's jump into the fun stuff. And as I said before, we are not trying to replace what anyone is currently doing in the oil and gas space, but more so to complement it. Because we all know this, but the oil and gas industry is one that's very cyclical in nature, right? So when it's hot, it's hot. When it's not, it's not. And what this does is it leads to a lot of uncertainty at times. And so what we want to do is we want to help prepare you and help you guys to diversify for those times that it's not as hot. So lots of the oil and gas professionals that we work with, they currently, just didn't know that there were options for more stable options for passive income than the stock market. A lot of people just know about the stock market, and that's why we're here, to show you guys what those options look like. So that's a big thing there. So the oil and gas industry, though, historically it's been pretty sensitive. It's a sensitive industry, sensitive to the outside world, sensitive to law changes, restrictions on new development, funding on pipeline projects, a whole lot more. And we want to make sure that you aren't basing your family's wealth purely on that industry, or in an industry that can be heavily affected by regulatory changes. Real estate, specifically multifamily, complements this and has proven time and time again to be a very strong, stable, and consistent way for you guys to create wealth for you and your family. Okay. 90% of the world's millionaires were created through real estate. I don't know where I read that, but I read it somewhere. So 90% of the world's millionaires were created through real estate. And we want to help you guys to be able to get into it, or if you are already into it, to expand on what you've already been involved with. And as I said before, nothing is going to compete with the oil and gas industry when it's hot, but this is purely to help those of you to diversify. And really what we want you guys to know is that you're not alone. There are ways to participate in these offerings. And if you've ever thought about job safety, or, BP, for example, BP, Schlumberger, Williams, just to name a few, all have had large employee layoffs. And so if you've ever been concerned about that or the volatility of the oil and gas prices and how that affects you, or regulatory and legislative changes, natural disasters, environmental restrictions and regulations, or just overall US general economic concerns or anything like that, we want you to know that now is the time to prepare yourselves and bridge the gap into alternative investments, multifamily specifically. Multifamily for us was the answer, and we're hoping that it can be the answer for you guys as well. So in fact, while I'm at it, I do want to introduce you guys to a very special guest that we have here today. His name's Shane Brooks. Shane's awesome. He currently is in the oil and gas industry. And so I'll let Shane kind of tell a little bit more about himself, but Shane is actually one of our passive investors and now close friends. He just had a newborn baby Baylor, with his wife, Bryn. So congratulations to them. They are amazing people. I'll hand the time over to Shane here really quick, but he's a fellow oil and gas professional like some of you guys, or most of you on this webinar. He's now redeployed his earnings into real estate, and now his money is multiplying and making him more money, but in a passive way. So Shane actually got in contact with me. You know, he was interested in real estate, reached out to me, heard me on I think it was a podcast. I'm not sure which one. I was a guest speaker on a podcast. He reached out to me. We met up, started building our relationship, and now he's been a passive investor in our multifamily deals. So Shane, why don't you go ahead, unmute yourself, tell us a little bit about yourself, where you work, and why is it that you started looking into real estate and bridging that gap for you guys, specifically multifamily.
Yeah, and Eric, I appreciate you guys having me on and excited to be a part of this. So I'll try to make it a little quick, but yeah, I've been in the oil and gas industry for about 11 years, currently work for Momentum Midstream in Houston, Texas. And so we focus mainly on the past few iterations in the Haynesville Shale. So that's mainly where our projects have been, but I've been in real estate as well personally for really the last 10 years. And as I got more and more into it, you can see the economies of scale and then the importance of time. And so for me, once projects came on board, we didn't have a lot of free time to do research, to invest into, or look at what stocks we wanted to get into, or what different investment vehicles there were. So a lot of times we just put money in savings, wait for a slowdown, and then we could decide how we want to deploy from there. So I realized that wasn't the most efficient and effective process. And so really started diving into multifamily, and luckily came across Gibby's Capital and Eric. And like he mentioned before, it really comes down to the team that makes a lot of these deals. You'll see a lot of importance around the market or the deal itself, but really the managing members can create that deal and the experience for the investor. So I decided to jump on board, and mainly because I knew, like, and trusted the team that they had in place, and their communication skills and the newsletters that kind of come out. And I'm sure Eric will kind of dive into a little bit more about how those kind of investments are structured and how that looks as a passive investor. But really excited to see where they go, and they've been growing like crazy. So excited to be here and help answer any questions on the panel as much as possible.
Awesome, Shane. Thank you so much, man. Also, when I talked to you before, you touched briefly on like the time factor here, right? So you were talking about how some schedules for oil and gas professionals are like 610s or something like that. So there's not a lot of time to, learn about this stuff. Can you elaborate a little bit more on that? Yeah,
exactly. So especially in the field, when we have projects going on, we have a lot of our crews that time is of the essence. And so we always have a deadline that's basically yesterday. And so we have crews that are out in the field 610. Sometimes if we got to go overtime, they're working 7 days a week. And a lot of times it's in areas that aren't their hometowns. And so when you get done working, there's not a lot of other items that you can do in the area where you're ready to go. So we typically see that either money gets just put in what's comfortable, kind of the stock market, the tried and true, what everyone's done, or it goes into savings and they kind of forget about it while they're out on the job. And like I said, a lot of these jobs can range anywhere from a few weeks to a few months to a couple of years. And so that time is pretty important for people that have to focus on the infield projects that they have going on, and maybe don't have as much time to focus on their wealth management back home.
Yeah, absolutely, man. I appreciate your insight there. Also just to, hats off to you too. For those that don't know, Shane, he's a young guy. What are you, 29, 30?
I just hit 30 last month. So
Just hit 30 last month, and he has invested into 9 different syndications at his age. And so I just respect him a lot. He has, put a lot of effort to multiplying his income and setting his family up. He just had a new baby. And so I love what he's doing. He's really setting his family up for a good future. So hats off to you, Shane. So really appreciate what you said. I'm sure some of it hit home with those that are listening.
awesome. Thank you so much, Eric.
Yeah. Now, so Shane touched on some, and I mentioned some earlier, but there are tons of benefits of multifamily investing. So I want to kind of get my team involved here a little bit. So we'll go through some of these benefits and just let some of them tackle some of them. So Brett, why don't we start with you? One of the benefits we talked about earlier was tax benefits. So do you mind jumping in and just kind of touch on what some of the tax benefits can be for investors in these multifamily deals?
Yep, absolutely. Thanks, Eric. I appreciate it. So, one of the things that was very attractive for us whenever we first got into multifamily was the tax benefits for it. As we looked for ways to cut our expenses, cut our tax burden. And to start off, everybody's familiar with the tax breaks that you get for the interest you pay on the mortgage for your home. In multifamily, you get that same kind of tax break. That also applies to a pro rata share of the LP investments that you make in these properties. But there are other things that are specifically for multifamily and commercial real estate. One of those is what's called a depreciation expense or accelerated depreciation. As an investor in multifamily, we get to deduct the depreciation expense as the buildings and the land and the property depreciate over time. As an investor, you also get to participate in that. Normally, before the Tax Cut and Jobs Act in 2017, there was straight line depreciation, and you can only deduct depreciation over 15, 27 years. But since then, we actually get to do what's called a cost segregation study, which we do for all of our properties. During that cost segregation study, we actually get to take all of the personal property that's attached to the building, so anything that's not the land or not the building structure itself, and we get to take all of that depreciation in the first year, which is why we refer to it as accelerated depreciation. As an investor in any of these properties, you actually get a share of that accelerated depreciation, which then passes through to either the entities that you use to invest in the properties or your personal taxes as it passes through. Other advantages, if you have other properties or other investments, then everybody knows that you have to pay capital gains tax. Well, fortunately, the 1031 exchange allows you to defer the taxes on those capital gains by taking that money that you made on that investment, and instead of cashing it out and putting it in the bank, you invest that into something else, and you get to defer the capital gains tax as you invest in other properties. And so the 1031 is a great. We also have other advantages like low income housing tax credits and opportunity zone investments. We don't currently have any of those investments, but in an opportunity zone, for example, you get to defer that capital gains tax by 10 or 15%, depending on how long you actually hold the property. So there are several different ways to reduce your tax burden. As everybody knows, oftentimes it's not how much money you make, it's how much money you get to keep. And any way that you can reduce that tax burden is going to allow you to keep even more of it.
Yeah, absolutely. Also, little disclaimer here, we are not tax professionals and not giving tax advice, but we're just trying to explain some of the tax benefits here for you guys.
That's right. So talk to your CPA.
Talk to your CPA, right? But no, great answer, Brett. Appreciate that. Another one of the benefits is diversification. So diversifying from stocks and bonds or, other traditional, avenues you might know. So why don't we have Caleb, why don't you jump in and touch on why diversification is important and how multifamily can accomplish this for passive investors?
Absolutely. Yeah. Thanks for the intro, Eric, and kind of teeing everything up the way you have. And I hope everyone's enjoying this tonight. And I know we certainly are. Real quick, I gotta say my professional legal disclosure, y'all. I am a professional, licensed financial wealth manager, and just make sure that nothing I'm being said is to be taken as direct individual advice. This is just generic information around balance sheet diversity, multifamily investments as a part of that in and of itself. So just real quick, have to get that out of the way. So, but yeah, so when we're talking diversification, and we say, most people say stocks and bonds, and that's just kind of painted with a broad brush. But what we're really talking about is a balance sheet that's efficient, and it's a trade-off between efficiency, regardless of the rate of return. Brett already hit on taxes, but also access to liquidity as well. And a lot of times when it's not done correctly, that's what I call an abuse of an asset. And so what we look to set up is creating a balance sheet that allows each asset you own to reach that optimal efficiency from both a taxes standpoint and an access standpoint, whether that be to realize it as income or to let the greatest potential return happen with that asset. Multifamily investments just so happen to have both of those features as an asset class in and of itself. So for the right investor, for the right segment of dollars, for the right portion of their balance sheet and the right time, obviously it could find a very nice place on the balance sheet to complement everything else, like Eric reiterated earlier. Think of it this way. A lot of times what we'll see with oil and gas professionals, and really any professional that has a very specific, unique field to have a lot of hockey stick potential on their income and their rate of return, business owner or something like that. We call it home run money, aggressive money, and safe money. And what I mean by that is that your home run money is something that you have unique access to that someone in the generic public market does not. And so I'll pick on Shane for a second, because Shane is a living, breathing, present oil and gas professional here on the team call tonight. And what I'm getting at with this is, Shane probably has a base salary. He probably has a bonus. If he's in a production role, he probably has some sort of commission or production, on top of a bonus. You have a 401k match. And then a lot of companies have a stock grant program of some sort. That's 5 forms of income within one industry, and a lot of times tied to one company specifically. And not that that's a bad thing by any means. Like I said, that hockey stick potential is there primarily because of that pretty unique exposure to a form of income that is uniquely associated with you and your opportunity. That's a home run space to live in. What we're talking about is going to be more of an aggressive segment with multifamily, in the sense that it has significant potential rate of return in the form of a multiple, as opposed to just a 5% or a 3% or even a 10% rate of return. Now, reinvestment's different, but that's the segment of the balance sheet that we're talking about, along with the tax benefits and tax diversity that Brett mentioned earlier. So hope that makes sense. And obviously I'm here to talk more individually as needed, and commingle efforts from the financial advising side as well. So, yep.
Awesome. Thanks, Caleb. Obviously, Caleb has a wealth of knowledge, and like I said, very grateful to have Caleb on board with our team. So that hits that one. One of the other benefits is that, we were talking about how multifamily investing can be a hedge against inflation. And so, Brett, did you want to jump in and talk about that one a little bit?
Yeah, I will. And
Okay.
It's not just a hedge against inflation, it's also a hedge against volatility, right? I mean, inflation is essentially a rise in prices or a loss of buying power. So your dollar today, as inflation rises, is not as valuable, a year from now as it is today. So one of the great things about multifamily investing, commercial real estate investing in general, but specifically multifamily, is the long-term lease, right? So as we have people go in, they rent for a year, some a year and a half, but we always have people that are paying us rent. So whenever you have standard market volatility, although things go up and down, but we still have those long-term leases, and that really helps give us some margin to the volatility of the market. Even during COVID, if you remember, if you're aware, but multifamily did very well, right? Because as COVID happened and as inflation happened, cost goes up, things get more expensive. Well, rent also goes up as things get more expensive, which is good for us and good for multifamily, because as rent goes up, then the net operating income goes up, the value goes up. But as costs go up, then it also becomes more expensive for people to live in their single family homes. As inflation goes up, to tame inflation, interest rates go up. As interest rates go up, then it makes it harder and harder to buy single family homes, but people still need places to live. So a lot of times they look for, places that are cheaper to live because their costs are going up. So they move into multifamily. So it really doesn't matter what happens in the market. It's going to be beneficial in the long term for multifamily investing. And the other thing to remember about inflation, it is time sensitive and is generally fairly short. Even when you look at 2008, it lasted for about 18 months, and then we got inflation under control. As inflation has spiked over the last 18 months here, as the Fed raises interest rates to tame that inflation, it's started to level off. It should start coming down, has already started to come down just a little bit. So the time sensitive nature of it, the fact that it's short lived also is a benefit for multifamily investing, because again, as things go up and things go down, our properties continue to appreciate.
Yeah, those are huge. So we've gone over a few of these benefits here real quick, but I want to kind of put a pause to it. Those of you guys that are listening, if you are trying to beat inflation, if you are trying to get and take advantage of some of these tax benefits because you make good income and pay the IRS money that you don't want to, then put in the chat, I am. Put I am in the chat. I want to see who's trying to take advantage of some of these tax benefits. I am. There we go. Shane.
And don't forget too, again, also like Caleb talked about, we're targeting double-digit returns. So as long as we outpace inflation, we're making money.
There we go. A lot of people here trying to all day. That's right, Matt. All day. So awesome. Thanks for that, guys. Another big benefit here is appreciation, just like what Brett was talking about. So in multifamily, in a nutshell, we get to benefit from two types of appreciation. So one of them is natural appreciation and the other is forced appreciation. So with natural appreciation, we are targeting properties in what we call emerging markets, right? So markets with high population growth, job diversity. And because of these factors, a property can naturally appreciate throughout the whole time and throughout the whole period that we have the property. Now, with forced appreciation, this is where things get good. Now, we primarily target properties with value add potential. And so where we can come in and decrease the expenses and make renovations at the property that can lead to increases in rent. So we can add things like reserved parking or covered parking or laundry machines or storage units. I know my dad at his multifamily properties in Oregon, he added laundry machines and storage units for additional income. So all of these things cost money, right? But they're also value add items. So they add value to the residents living in these communities. So we can quite literally control and force the appreciation on these properties. It's an amazing thing. And so the benefit is you guys as investors get to benefit from the upside of that appreciation as well. So appreciation is huge, definitely something to consider when evaluating a multifamily deal. The next one though, and it's actually a really big one and what I think is a common misconception, but it's the fact that multifamily properties are easier to manage than single family. So Megan, why don't you jump in? We haven't heard from you yet. So why don't you jump in and kind of talk on this one?
Absolutely. Thank you, Eric. I appreciate it. So I think that a lot of times when people think about investing in real estate, the first thing that comes to mind is that single family home. I know that a lot of people, as they ease their way into the real estate market, that's a great starting point. But there are some vast differences between the two. So let's just start with the barrier to entry. So, your single family homes, your average cost is going to be $300,000 to $400,000. Sometimes you can get in a really good bargain for as low as $100,000. It is easier to enter the marketplace that way. And the inventory, depending on which area of the country that you're in, can be pretty wide as well. With multifamily, however, the minimum cost, you're talking millions of dollars. They're more expensive. The marketplace is definitely smaller. However, there is a lower cost per unit and higher cash flow than single family. We also have more lending options, even when the marketplace is upside down, as Brett has expressed, when the marketplace fluctuates, we have different lending options. We can go agency, we can go bridge, and we have some of those options to give us the best value for that purchase. Hold times can be different as well. Single family, you're fixing and flipping for a quick buck. You're going to hold between a week to maybe several months, depending on what your plan is to renovate. With multifamily, we have a longer hold time that gives way to that value add forced appreciation that Eric was referring to, which means cash flow and equity gains for the passive investor, as well as the tax benefits that we've done a pretty thorough job of going over already. We also get to benefit from economies of scale. So if you take occupancy, for example, with a single family home, if you have a tenant that, skips out on you and your property is going to remain vacant for, say, 3 months out of the 12. So your occupancy rate for that year is 75%. But however, with multifamily, one of our properties, our average size is about 130 units across our portfolio. And if we have a tenant that's, evicted or skips out on us and the rest of our tenants stay, then my occupancy rate for that year is a 99% versus a 75%. So economies of scale are very beneficial in the multifamily realm. Contractors also, finding contractors for our work. So when you're dealing with contractors, quality and communication are really top things that I look for. And the quality and sophistication of a contractor whose average job size is, say, $50,000 is going to look very different than somebody who's handling 500,000 to $2 million in jobs. Our average CapEx projects for turning these properties and improving them across the board, averages anywhere from $500,000 to upwards of, $1.2, $1.3 million as we're looking at executing our business plans. And the cost per occupancy or per occupant of maintaining a 130 unit building is generally much lower when you compare it to the figure of a single family unit, with just 1 or 2 renters. We also engage third-party management companies, and those have an on-site manager plus in-house maintenance. So depending on the size, we may also have a leasing agent as well as a porter that helps out our maintenance crew. This saves us time and money, as well as increases tenant satisfaction when their issues are being handled immediately versus having to wait for a contractor to be found, located, scheduled, coming out to handle, the concerns that are going on within each person's units. For single family homes, you're doing the majority of the work yourself, including those 3 a.m. calls to unclog toilets. Being a passive investor versus an active investor, there's a big difference as far as that goes too, which I know we're going to get into a little bit later. So I don't want to jump ahead too much.
Yeah.
Does that answer what you're looking for?
No, yeah, no, that hits the nail on the head. Megan, thank you so much. Megan is our asset manager. She has so much knowledge. She has that beautiful eye. She can go into a room and be like, oh, that's mold or that's water damage. And we're just grateful. Like, she has so much experience and knowledge, and she's a huge asset to our team. So thanks for that one, Megan. One of the other ones is just the fact that multifamily investments can be, there's greater stability in them. So Caleb, why don't you jump back in and talk on that one for a sec?
Yeah, sure thing. And real quick, I think to be hopefully more relevant instead of generic, just with the crowd we have today. I mean, a lot of people, this is not their first rodeo discussing investments in real estate. I'm assuming most people started in residential real estate. I know, obviously we did. I know, Jim has as well, with a lot of experience on that front. And Megan's already touched on a lot of the points of just the stability of multifamily investments versus a residential investment. And so I think that will be more relevant for the crowd that we have today, just with the prior experience and whatnot. And really, it's just talking about the hedge of the multifamily space and the economies of scale that Megan discussed as well on both sides, right? If you have a 4-unit or you have 4 tenants in your current property and 1 tenant leaves, potentially your cash flow just reduced by 25%, right? Just throwing out simple numbers here. Versus a 200-unit, complex, and 1 person leaves. I mean, to have a 25% fallout, you have to have 50, tenants exit at the same time. And the risk of that happening, sure, there's always a risk, but the likelihood is much less significant with 1 person, needing to move locations or move out. Same thing from the economies of scale on changing rents. People think that, your rent's going to double or triple or just do something crazy potentially. And that's really not the case. I mean, even raising rents $100 per tenant for 4 tenants versus $100 per tenant for 200 tenants, and throw a 10x multiple on there just to throw a number, throw 5x or 10x or just whatever. And the return is significant. So just hedging against what could happen from tenants leaving and changing, but also from these minor repositions that Megan is overseeing to make the property better. And like Eric was alluding to with Jim earlier, creating value add for the community that wasn't there previously as well. So if there is changes, it's not as felt, or it's not as immediately realized, because you have such a larger scale of tenants to kind of hedge against something negative, but also give you more upside for any positive changes as well.
Cool. Very good, Caleb. Appreciate that one.
Yeah.
And we just have just a couple more benefits, and then we'll get close to wrapping up, you guys. Appreciate you guys staying with us up to this point. One of the last ones is just the fact that this is completely passive in nature. And I think that's important for those that are listening to understand what that means. And so, when an investment is passive in nature, what does that mean for the investors, Megan?
So that's really the beautiful thing about all of this. As a passive investor, you basically get to sit back and collect what we call mailbox money. As the managing team, we're the ones that do the heavy lift. We're building the relationships with the brokers. We're finding and vetting. We go through probably hundreds of deals each quarter before we narrow it down and find the property that we want to invest in. We're extremely picky. We research the markets, the area demographics, and get down into the macroeconomics of the markets to ensure that they're going to support the business plans that we come up with and give us the type of returns that we like to see. We perform all of the due diligence. We do all the physical due diligence, as well as going through the financials and the leases and all of that. We hire and vet the third-party management companies. And then, as people have mentioned already, we do find ways to force that appreciation through our value add model. We drive the rents. We charge pet deposits and rents, bringing other services that will benefit the tenant base, valet trash, covered parking. We've given a few of those examples, but let me give you the really cool thing as a passive investor that you get to benefit from all of our hard work on our end is, so let's say I bring in a package delivery service that's going to net us an extra $15,000 a year. Over that 5-year hold, that amounts to $75,000. That $75,000 at an exit cap rate of, say, 6.5% is going to equate to an added value of $1.5 million in improved equity for that property. That's that forcing of the appreciation that we do. That is such a beautiful thing. And we're the ones driving that business plan throughout the hold. We take care of the entire acquisition through disposition process. And you, as the passive investor, get to sit back and collect that mailbox money, which is just awesome. And we've already touched on the tax benefits and all that good stuff too. So who doesn't want to be an LP? That's my question. Who wouldn't want to do that?
No, yeah, I love, like, personally, I love the passive nature for investors. And so, here's the thing. A lot of the people that have the ability to invest in these deals, they make good income. They're very busy with their families and their other businesses. And so a lot of those folks don't have the time to go become an expert of the multifamily space. And that's where we come in. So the last one and my favorite one is cash flow and equity, guys. So our multifamily distributions are given out in a combination of 2 ways. One, cash flow throughout the hold. And like Megan was saying, and also the second one is upside from the equity when we sell these properties. So you put your money in, you get quarterly distribution checks in the form of cash flow, which is basically, it comes from the collected monthly rents at the property. And then after we execute all of our value add strategies, we increase the property value significantly. And there is a ton of equity that's created on these projects, right? So, which you guys as investors get to benefit from all of that equity creation as well. It's a beautiful thing. So those are a lot of the benefits, guys. We have explained a lot. Hopefully you got some value from that. Now, I really just want to kind of touch on one thing, and I want to stress the importance of timing here, guys, because there is going to be more opportunity in the next 6 to 12 months than in a long time. And the teams like us at Gibby's that are well prepared will be the ones that capitalize. And yes, interest rates have gone up, but with that, purchase prices have also began to drop a lot. And this has resulted in a ton of opportunity that you and us can all take advantage of. So, you look back at what, 2008, 2009, and a lot of people lost a lot of money, right? But at the same time, there were tons of people that also made their fortunes at that time. So let's all together be on the right side of this thing. Okay. So, and like I said before, it's more important now than ever to be aligned with a strong team like Gibby's Capital to help secure your family's wealth and your family's future. So that is kind of the nuts and bolts of things. I do have a couple quick poll questions for you guys before we open up to Q&A. Right after this, we're going to do a Q&A. So any of you that have questions, we'll type them in the chat here in a second, and then we'll answer those questions openly. But I do have a couple poll questions for you guys. So Megan, why don't you queue those up? There's just 2 or 3 of them. I'd like you guys to participate in those. So the first one is, did you guys learn something and get value from this presentation? You can say no if you didn't, won't hurt our feelings.
It'll help us to
But
be
say
better
yes.
next time.
But
Nice.
say yes. Awesome. Thank you. Let's go to the next one.
There you go.
Okay, that's the results from that one. Is it going?
There you
we
go.
go. Okay, the next one is, do you want to partner with us on these types of deals and these opportunities? Yes, yes, yes. All yeses. Great. Still got some more coming. Hope I can see all the yeses.
Yeah, I can see them all. 100% yes
Okay.
across the board so far.
Great. We'll give it another second or two in case there's anyone else. Oh, that's everyone. Okay.
Yep. 100%.
Great. Sweet. Great. Let's move to the next one. Do you want to partner with us? We answered that one. Okay. Do you want to book a call to learn more about these types of opportunities? Yes, please reach out, or no, not at this time. Awesome. Okay. Perfect. Cool. Thank you, guys.
Awesome.
And I think I have one final one. Maybe not.
Yes.
I do. Okay. Yes.
One final one.
Do you want to know about future offerings and be on our Investor Club email list, where you get an exclusive email when we have new offerings that do become available?
No, I hate making passive income.
Hey, I put that one in there. Got to throw a little personality in here, guys.
Naturally.
Love that.
I was just like hoping that we had that one person so I could just pick on them, but
Yeah.
awesome. Great.
Too
It
many
looks like we
smart
got
people in this
across.
group. Yeah.
Yeah.
Yeah. Across the
awesome.
board. Yeah. We're happy to add you guys to that list so you can stay informed when we have future opportunities. So yeah, so thanks for taking the time to answer those questions, guys. That type of feedback helps us get better and helps us to tailor these presentations in the future to you guys, and so we can add the most value that we can. Now, lastly, I just wanted to take a second. And so first off, if you enjoyed the idea of investing in multifamily and learning a little bit more about this, we do have a deal under contract right now. There still is some availability in it. As I mentioned before, it's about 50% subscribed already. We've only had it open in the last week, so this one will fill up quick. And these deals are offered on a first come, first serve basis. So if you are interested in learning more about this and this opportunity, then I'll have Megan put my info in the chat box real quick. What she'll put in there is a link to our investor portal for this current offering, and also a link to book a meeting with me directly. So you can ask any questions that you want about the deal. Or if you just want to hang out with me and get to know me a little bit more, feel free to book one as well. I'm an open book. So Megan, do you mind putting that in there?
Yep. I'm going to put it out there to everyone in the chat. There you
Okay.
go. So that is the first one. That's a link to the investor portal. And you'll find a lot of great information there within the portal. And then this next one is going to be a link to book a meeting with Eric. There you go. It's all in the chat.
And what you can expect if you do invest in these properties with us, what you can expect is you log into the investor portal, you'll register there. You'll be able to see all the details of the offering. You can also, book a call with me anytime, discuss the opportunity. After that, we'll sign the subscription documents for the deal. We'll wire the funds for your investment. You'll be a part owner in this deal alongside us. We also passively invest alongside you guys in each of our deals. So we also have skin in the game. And then after that, what you can expect is a monthly report every single month going over what we've accomplished at the property the previous 30 days. And then we also do an in-depth quarterly report as well. And as I mentioned before, as far as the cash flow goes, there is quarterly distributions that are sent out to investors that are participating on these deals with us. So feel free to book a call or go into the investor portal and register. We're happy to connect with you guys on that. So lastly, guys, before we start the Q&A, if you have any questions about any of what we just went through, or you just want to speak to someone, then please do not hesitate to reach out. We are more than willing to help in any way that we possibly can. And just to make sure that once again, that this is the right investment for you. And that is pretty much all, my friends. So as sincerely as I can possibly say this, thank you guys for making it this far with us. It was a lot to go through. I know that. And we are extremely grateful and excited that you joined us tonight. So thank you guys again for your time. And we will now open it up to some Q&A. I think we had a couple questions come through the chat, so we can kind of sift through those.
We have Dylan Davis was asking, do you plan to discuss typical time frame and typical expected ROI? Also, how many people do you involve in each purchase? Do you have a minimum requirement to control the investment group?
Yeah, sure. So I'll happily jump in and touch on that one, Dylan. And yes, so typically we're holding these properties for 3 to 5 years, but really what it comes down to is what's going on in the market. So, I mean, there's been times with some of our business partners that we've done deals with where they will, have a 5-year hold time, but then sell in 2. And so it's all dependent on the market. But, honestly, if we can hit our 5-year projections in 3 years, then certainly we will look at selling if that's what's best for our investors. And so that's kind of usually our typical time frame that we're projecting is 3 to 5 years. As far as an expected ROI, what you'll never see us deviate from our normal investment criteria. So for us at Gibby's Capital, we usually will not pursue a deal unless it's a minimum annualized return of at least 18%. And so, for math purposes, just to give you guys an example, if you put in $100,000, which to answer your other question, that is typically what our minimum investment is, $100,000. If you put in $100,000 on a 5-year hold, and if we hit a 20% return on that property, you would essentially turn $100,000 into $200,000 in that period. And that's including the return of your capital. So that's just to give you an example of how that would look as a passive investor. And as far as how many people are involved in each of these deals, it's really, like I said, on a first come, first serve basis. Typically the minimum investments are $100,000. And so if we have a $10 million raise, there's probably going to be quite a bit more investors than if we have a $2 million raise. But our average investor normally comes in between 200,000 and 400,000. And so because of that, lots of times there's fewer investors on the deals. If we had just a ton of investors coming in at 100,000, there'd be quite a few, but that doesn't necessarily change your percent in any way, because your percent is related to the amount of capital that you're investing into that deal, proportionate to our equity raise on the property. So hopefully that answers that question. Anybody else want to touch on that?
Well, I'm wondering if part of the question, do we have minimum requirements to control the investment group? Maybe Dylan, are you asking if it's like accredited investors versus non-accredited? If that's the case, most of our deals are 506C for accredited investors. So I'm not sure if that maybe was part of your question or if it was something different, but
no, he just typed that into the question. So yes.
Oh, very good. See?
Good call.
All right, I
good
got
call.
it.
Good
Nice.
call.
So Dylan also had a question. Can you show what type of updates LPs get? Is that via an app or an email or what?
Yeah, great question. So we have in our investor portal, we believe in full transparency. So you can see updates on the property in your investor portal. You can see updates on, your distributions. You can get access to your K1 annual investor reports there, investor statements. So you can submit that to your CPA. So the investor portal is where a lot of this stuff will be housed. Now, also in the investor portal, we will upload every single month our financials for the property. So you can see every dollar going in and every dollar going out. We think that's really important. I'm not sure that all operators do that, but the good ones do. And so we will upload the financials every single month for you, which is really good. Not all investors look at them. Some do, some don't. Totally up to you. I know my dad does. He looks at them every single time. So he scans those things very closely, which is great. We love it. But hopefully that answers that one. But also on top of that, you'll be getting an email with an email update every single month. We also send out a monthly newsletter, which is a combination of updates on our company and also updates on the market, the multifamily space in general. That's a monthly newsletter that goes out as well. So hopefully that answers that one, Dylan.
We also like to throw in little things that are going on at the property. It's the human factor. We wouldn't have our business if it wasn't for our tenants. So we do different events for our tenants throughout the year. So you'll also see in the newsletters some of those things come across. Like when we take over a property, we do a meet the staff event. So whether that's a breakfast or a lunch or just a quick stop into the office, we help celebrate holidays with our tenants and all those kind of fun things too. And we try to do a lot of incorporating of the community as a whole. So you'll get a little snapshot of those things in your updates as well.
Didn't we do a jump house at Coventry, was it?
We did it
for the
at
kids?
Oasis. We worked
Oasis.
with a local
Yeah.
church and they did a huge back to school outreach for not only our tenants, but for the community as a whole. And they gave away backpacks and school supplies, and they had a bounce house, and they did free haircuts, on site. We had a company that's local that has a mobile hair cutting salon, and they came out. So we love doing stuff like that. That's the favorite part of my job. Quite honestly, I love that stuff.
Yeah, and I work closely with Megan on those updates. She sends those out to me because she's working hands-on at the property or with the property management company quite a bit. So she sends me over what the progress is for the previous month, and I portray that. And so also to touch on that, to answer Matt's question, what type of communication do you provide for LPs? Oh, where'd that go? And to get updates on the reposition. So one, we do that monthly, the monthly update every single month. But with that, it's not just words on paper. Megan's really good at documenting before and after pictures. And so in each of our updates, there'll usually be some sort of before and after pictures. If we change the flooring or the countertops or cabinets, lighting. And so we're really good at documenting that and showing investors what's actually happening at that property. So I think that's huge. A lot of people like to see that and get visuals.
With our larger CapEx, projects that really make a difference for the community, like replacing the roofs or, addressing potholes in the concrete and the parking lot, things like that. So we like to show you all those things that are going on.
Cool. Looks like we had another one from Dylan. Do you require accredited investors? Yes, we do. In most of our offerings, not all of our offerings are exclusive to accredited investors. Sometimes we have done, one of our deals was a 506B offering, which was open to non-accredited investors. It's not every day that we do those deals, but even if you're not an accredited investor, then we encourage you to stay involved with Gibby's and stay in touch, because it might come to the day, one point where you do become an accredited investor, and we will be ready to offer you those opportunities at that time. And you also never know, we might have opportunities that are open to non-accredited investors. There's also something new that's been going on. A lot of multifamily operators have been doing this, but they're doing a split offering where it goes from a 506B to a 506C offering. So we can do that as well, where for a very short period of time, maybe 1 week or 2 weeks, we'll keep an offering open for non-accredited investors to come in and participate. We are only allowed to accept funds in that small window, 1 to 2 weeks, whatever it may be. And then we'll close that offering out, open up a new offering for 506C accredited investors for the same property. So that is a way that we're doing it in the future as well. So if you're not accredited, don't worry.
Eric, if I could just add in there too, with the 506Bs, we have to have a pre-existing relationship in order to offer that. So if that is something, if you're non-accredited and that's something you may be interested in the future, definitely schedule a call with Eric so that we can get to know more about you. Don't need to know what you had for dinner last night, but we really do. This is a relationship business, and we really do like to get to know our investors and what's important to you and what are your goals, your long-term goals, your short-term goals for your financial portfolio, and see if we can, figure out ways that we can help make some of that happen. But a lot of that is just really us getting to know you and you getting to know more about us so that when those 506B opportunities open up, that you can be on that list of people that we would, share that offering with.
Yeah, excellent. That was great add in there, Megan. And then also Dylan, as far as the investor deck, pitch packet, property packet, a lot of different things that it's called. They always have images of the property. And then at the very end of them, and also too, if you scroll up and see that, and we can have Megan post it again, but if you go into the investor portal and you can see an example of what our investor deck looks like, you can see the Village West property that we currently have under contract. If you go in there, you can see typically in these investor portals, we'll put our property packet. We'll also put drone footage for the property. We like to do that because we like to think that it helps our passive investors if they can get eyes on the property, especially if they don't live nearby. So we like to go get professional drone footage done. It's really well done. And so usually you can see that in there as well. And so as far as the actual portal, at usually on the very last slide, there's a kind of a picture of it, but you'll see for yourself if you ever log in, you'll see what that looks like.
So Francisco Santos has a question. What are your targeted rates of return that can be expected? I think we may have touched on that a little bit, but we can revisit it. And then knowing that each deal has its potential risks.
Yeah. Megan, do you want to touch on that, or Brett?
Brett, why don't you take that one?
Yeah, sure. So like Eric said, our targeted returns are at least 18%. So whenever I get a deal and I underwrite it, then that's the targeted annual return. Depending on the length of the deal will determine kind of what the long-term equity position is. But generally, we try and get at least 18% on annual returns. And you're absolutely right. There's always risk, but we try and mitigate that risk in several different ways, including very conservative underwriting, business plans that we put a lot of time and energy into. Megan takes a lot of that into account whenever she's executing the business plans. We work very closely with our property managers. We have really good insurance. So we kind of adopt the mantra to hope for the best, but plan for the worst. And it has allowed us to be very successful so far.
So we had one other question from Michael, and it says more investors cost more. Michael, I'm not quite sure if you could elaborate on that question a little bit, help us drill down and get you the answer that you're looking for. In the meantime, Dylan was asking, have you bought and sold any properties yet? Who wants that one?
Oh, I'll take it. Yeah. So
Okay.
we've been in the multifamily space. Like Gibby's Capital itself has existed, for just about 2 years collectively. But members of our team, we've got, I think it's over 36 years of experience, almost 40 years of experience. And so combined between us, there are part of our team members that have gone full cycle on deals. That's Jim, my dad. He brings a wealth of knowledge and experience to the table. That's why part of the reason why we brought him on board is because of his experience, both with acquisitions and disposition of properties. For us, in the last 2 years, we've acquired 5 properties. We're about to close on the 6th one here shortly, which is Village West, which I brought up to you guys. And so once we close that one, that'll be our 6th property in the last 2 years. And because it's been a short time, we haven't yet gone full cycle on those deals or sold them. That being said, though, we are getting quite a bit of interest in a couple of the ones that we've acquired last year. We've already gotten offers. We bought the Oasis for what, 13.4, was it?
Mm-hmm.
13.4 million. We've already been getting offers for around 18 million. So that's, instantly right around $5 million of equity that we'd be able to share with our passive investors. Now us as a team collectively have decided not to take offers at that, at that price point, but we would entertain them if they came in around 21, 22 million, I think. Brett's our numbers guy. So if he says it makes sense for the investors, then I go with it. But yeah, we're already starting to get offers on our properties that we have acquired, but we haven't actually sold them yet.
So Michael has said cost for tax returns was regarding his question.
Cost for tax returns.
So whenever it comes to your tax returns and we talk about the depreciation expense of that, then all of that is put together for you and sent out in what's called a K-1. And all of the portion for each individual investor depends on how much you invest, so that whenever we dole out those tax benefits, then it's all on a pro rata share basis. So the bigger piece that you invest, then the bigger piece of the bigger share piece that you get for those tax benefits. So more investors don't necessarily cost more. You can have fewer investors with bigger pieces. So I mean, it just really just depends.
Yeah, there you go. Also, I just want to say hi real quick to Seth Sundberg. Man, Seth he's a 7-footer as well. I think his company's name is 7 Foot Finance. I remember meeting Seth for the first time out in Dallas, last year. There was a Shark Tank event, and we all did a deal presentations. Not all of us. There was actually 4 groups, and Seth was one of the presenters presenting a deal. I think it was in Louisiana. But anyway, I just remember
New Orleans.
New Orleans. I remember how awesome you did, Seth. You did a killer presentation. And so hopefully that deal ended up going great for you, but happy to see you on here with us today. So
For sure.
All right, guys, I think I'm not seeing any more questions come in. So that being said, Seth, love y'all. Love you too. Thanks, man. I appreciate you guys. Really, really, truly do. Appreciate the support. Thank you guys for coming out. We took an hour of your time, on a Tuesday night. So truly thank you for your time and coming out and taking the initiative to learn more about multifamily. And we hope, and we really, really do hope that you guys got a lot of value from today. Feel free to tune in to future webinars. We're going to be doing these probably about once a month on different topics. So stay tuned. You'll see them in our email campaigns. You'll see them on our social media. Feel free to register. Each one will add a new piece of value to you. We'd love to see you guys in the next one. Thank you guys for your time, and we'll see you next time. Now, how do we end it?